right? So now we move to the calculation of a bond, right? The first type of bond, this a bond with maturity, right? It has coupon rate as well as maturity period. So for that kind of bond, we have to apply this formula, right? This formula. B naught is mean value of the bond today. Value of the bond today equal sum of, right, total of interest at the time period T, interest over 1 plus KD. KD mean cost of debt over the time period, plus maturity value, that is BN. BN is maturity value, and 1 plus KD cost of debt into the in the end period N, right? So we will move for the calculation. Right? Example, suppose an investor is considering the purchase of 5-year 1,000 par value bond, right? Bearing a nominal rate of interest 7% per annum. The investor's required rate of return is 8%. So what would he be willing to pay now to purchase the bond if it matures at par? Right. For your understanding, I ask some basic questions in this example. Right. The first question, what is the face value of this bond? How much? You write the answer in chat box. What's the face value of the bond? What's the face value of the bond? Please type your answer in chat box. Thousand, yeah. Right, good, very good. All of you got the idea, right? What is the coupon rate? Coupon rate of interest it pays. How much? Par value is 1,000, right? And the rate of interest is the coupon rate. Coupon rate, how much? Coupon rate 7%. Good. Yes, 7%. And maturity. Maturity. Maturity, how many years? 5 years. Yes, good, good. And KD, cost of debt. Sometimes we call required rate of return. If he put the money on into the bank, he will expect minimum of how much? The rate of interest. Good, good. Yeah, 8%. Right. These are the basic example, basic information from this example. So we have to find value of the bond. Today, right? Value of the bond today. This is questionable. Right? This is the question. Now we will move to the equation, right? This is the equation. Right, to find out the value of the bond today, we have to take uh, interest. So per period, and if end of each period, each year, how much in the amount of interest you will receive if you purchase this bond today. End of year one, cash flow, right? Here you have zero. You have purchased today. You have purchased this bond today for 1,000 rupees, isn't it? So you are not purchased, no? Right. Year one, year two, year three, 4, 5 years. End of first year, how much you will receive as interest? You have purchased the bond value is 1,000, right? You have, if you purchase this bond for 1,000, how much interest you will receive from this bond? How much? 7, no, wrong. 70, yes. 70 rupees. 70 rupees. End of year one, you will receive 70 rupees. And year 2, 70, right? Get 70, 70, 70 for 5 years. You will get 70 rupees end of each year, right? Then, right, end of 5th year, you can redeem your bond at maturity value. How much maturity value of this bond? Maturity value, how much? Maturity value, how much? You can submit the bond to the company, issuing company, and you will receive the maturity value. How much you will receive end of 5th year? No, 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 1,300. No, 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 no. I don't know how you got 350. Yes, normal Sanjeev says 1,000. Right? In this example, they not especially indicate the maturity value. Therefore, we have to assume that the maturity value is equal to its par value. Therefore, maturity value is 1,000. Right? Maturity is 1,000. So, on which year you will receive this money? This 1,000 rupees? End of which year? 5th year. Good. End of 5th year. Right? So therefore, end of 5th year, you will receive 1,000. 1,000 is what? It's maturity value, and 70 rupees is interest. Right? Now, these 70 rupees are present value or future values. These 70,000 are future value or present value. These values are present value or future values. Right, good. Now we have to convert into its present value. We have to convert into present value. To convert to present value, we have to do a discounting. So, what's the discounting factor in this example? Discounting factor is 8%. If you put your money into the bank or somewhere else, you can earn 8% interest, right? 8% interest. So how we find what is the discounting factor uh, at end of year one? Discounting factor at end of year one? Simple, very simple, right? 1, right? 1 over 1 plus R. R is 0 here, 0.08 into period 1. Period 1. Isn't it? And what is the answer? Do it in the calculation. It's a present value. What is the present value? Discount factor. Nine 0.926. 0.926. Right? 0.926. Then we get put equal sign equal equal right? So we convert into decimals. Right. Now for this here, here we have to find discount factor for which period? End of year, 5th or 6th year. So we will receive this 1,000 rupees end of 5th year now. So therefore we have to take the same value here, right? The present value at end of year 5. Now we convert this value, present value, future value into discounting factor. Then we will receive present value of this future cash flows. Present value of this future cash flows, right? Then now we will get total of this value. How much? Then what is the value? Right, 960. 960. Please check the answer. Right, have we got the correct answer? Yes. Have we got the correct answer? 960. The value of the bond is 960. Right? Value of the bond is 960. Our calculation also 960. Right? Any clarifications, any issues, any unclear area in this calculation? Any questions? We have taken, yeah, same answer. We have obtained the same answer. Here 960, here 960. Right? Right. I will give you one exercise. Right? Assume that yes. Assume that the same example, right? Here the same example, same information, right? Same information. The coupon rate now is 10%. Coupon rate is now 10%. There's no changes. Then what's the value of the bond? Please do the calculations and let me know the answer. Please do it. I'll give you 5 minutes and find the answer. Do it fast. Right? Yes. Yeah. Isur Fernando said 1079 and Darshika 79, 1008. Right, good. So you have got the point. Yes. Yes, all of you got correct answer. 1079.8 correct answer, and also 1080 also correct answer. Uh, right, right. Then now the discount factor is 10, right? 10. So we have taken this value using formula, isn't it? We have taken this value in formula. Now we will study how we can take this value without formula, without calculation. Rather, we will take this value from a from a present value table, right? So the present value table, present value table. I don't know. Yeah, right. Present value table. If here we have to move to present value, right? Present value interest rate. Then what is the rate of interest in the early example? 8%, no? 8%. It take 8%. 8%. And year one, 0.9346. Check the answer. 9346. Sorry. 9346. And year two, so 9259, no? 9259. 9259. Right. Yeah. We wish we can make, right? Yeah. We can take this value from here. Right now, we will do calculation for at 10% discount. Discount factor is 10%, right? Then we can take this value from here. For year one, we take 10%. No, with the value is here, and the table for second period at discount factor 10%, and sorry, sorry, I am doing wrong. Right. Now the coupon rate is 80. No, coupon rate is 10. Then he will receive 100 rupees as interest. 100% is interest. Then the answer is 1079. Right? Clear? Clear? Okay. I may confuse you, right? Okay. Okay. Then right. Same information. Uh, Same information. If coupon rate is 8%, what is the value of the share? What is the value? What is the value of the bond? If coupon rate is 8% and required rate of return also 8%, what's the value of the bond today? I can say without doing any calculation, I can say the answer. What will be the answer?
What will be the answer? What will be the answer? 1000. Yes. Yes. 1000. Yes. 1000. Because here we will get 8 rupees. 80 rupees. 80, 80, 80, 80. Now, answer 1000, right? The value of the bond is 1000. So, have you observed there is a relationship? There's a relationship, right? Here I put par value. Par value is 1000, right? Par value 1000, and coupon rate at the first time it was 7%, and year of maturity, number of periods, right? 5 years, and cost of debt it was 8%, and the value of the bond, right? Value of the bond, how much? The first time 1000 or 900, 960, 960. Right, 960. And second time, par value 1000, coupon rate was how much? Coupon rate. Second example, 10%, right? And cost of debt is same. Now, 1080, 1080. And if coupon rate is 8, then it's become 1000, isn't it? Have you observed this behavior? Have you observed this? Right? We can come to the conclusion, right? Before that, I will ask a question. Before that, I will ask a question from you. Market price of the bond now, say market price of the bond says 1000, right? Market price of the bond is 1000. So, but your decision is what? Will you buy or sell this bond? This is option A, bond B, bond C, right? Yes, there are 3 types of bond, right? A, B, and C. Do you buy bond A? The market price it was 1000, but its real value, implicit price, real value is 960. What will be your decision? Will you buy the bond or will you sell the bond? Right. Sell the bond. Yes, we have to sell the bond. The decision is we have to sell because market price is 1000. It's a higher price. The real value is 960. Then we can make profit. How much profit we can make by selling bond A? How much you can make profit? Yes, exactly. Isuru says, yeah, all people. Amarasiri also, yeah. Kavi. Then bond C, will you buy or sell? Buy. Yes, we will buy. Real value is 1080. Market price, offer price is 1000. Now we can get profit, kind of profit by purchasing this kind of bond. How much profit will be? Good. Yes. And bond C, will you buy or sell? This time we can't take a decision. We have to consider other factors. We have to consider other factors. So if it's yeah, who says buy or sell? Yeah, Sandamali says we can buy or we can sell. Both decisions are rational decision. Assume that all factors are not changed, constant. This time buy or sell, right? So the decision is what? Here you compare the coupon rate. The coupon rate is 7%. Cost of debt is 8%. This time, uh, coupon rate is less than coupon rate is less than cost of debt, isn't it? Coupon rate is less than the cost of debt. This time, it's become the value. The real value is become low. This time is called discounted bond. Discounted bond. Discounted bond. Right? Discounted bond. The price of the bond, real value of the bond is less than its face value. This time, this type of bond is called as discounted bond. Discounted bond. So here, coupon rate, the bond value, the bond B, coupon rate is higher than cost of debt, isn't it? This time, the real value of the bond is higher than its face value. This time, this bond is called as what? Premium bond. Premium bond. So bond coupon rate equal cost of debt. This time we call as par. Right? It's par. No premium, no discount. Right? We got the idea? Clear? Is it clear? So based on by comparing the market value and its real value, we can decide it's a discounted bond or premium bond. If the bond is discounted, the best option is sell the bond, right? If the bond is premium bond, you buy the bond, right? You buy the bond. And par, value at par, right? Bond at par. So these are the things we have to have a clear idea on this. So there are so many shortcuts to find this value in a quick manner, right? By using the table, right? If you want, I can explain, or it's easy for you, no? It's easy, no? So there are some shortcuts to find out this value. So here, all values are equal, no? All values are equal. So we can apply annuity formula, annuity factor, right? Shall we do for this? For one, shall we do it in another way? Okay. We can use table now. Here the same example. Here, right. Value of the bond equal interest, right? Interest into PVIFA, right? PVIFA plus, right, plus maturity value, right? Maturity value into PVIF, value of the bond, equal interest, right? Interest, right? Interest into PVIFA plus PVIF mean present value of the bond equal interest into present value interest factor annuity, right? Present value interest factor annuity plus maturity value into PVIF, present value interest factor, right? This is the formula, right? Here, interest how much in the first example? Here, interest, this example, 10%, right? Coupon rate is 10%. Then how much we will receive interest? How much? 100 rupees, isn't it? Interest is 100 rupees. Yeah, interest, simply interest is 100. And maturity value, how much? 1000. Right? We have to apply here what? PVIFA. PVIFA. So how do we calculate PVIFA? There are two methods. Either we apply a formula or we can use table. Right? Here this table is about present value interest factor. Right? Present value interest factor. No. We have to apply present value interest factor annuity. Yeah, annuity. Present value interest factor annuity. Yeah. Present value factor annuity. Right. Annuity, what's the discounting factor? Cost of debt is what? What's the cost of debt? Cost of debt? Yeah, cost of debt is 8%. Cost of debt is 8%. And what's the maturity period? Maturity period? 5. So therefore here, year 5, then we have to find the period year 5 and at 10%, not 10%, 8%, no, 8%. Discounting factor is 8%. So simply we take this value. Right, which is interest factor. And maturity value 1000 into PVIF. Then we have to apply. Then we have to move to this table. Present value interest factor. Right, present value interest factor 8%. Right, 8% after 5 years. Then the value is this. Right, now see the answer. See the magic. 100 into value. Right, then see the answer. Right, have we got the same answer? Have we got the same answer? Right. Clear? Right. You don't need to waste your time. Right. You can apply this table and you can do the calculation directly. Right. Within a minute, you can find the answer. Right. I will give you another example. Right. You do it quickly using this method. Right. Say par value, face value. Right. Face value is 100. Right. Coupon rate is 9%. Coupon rate is 9%, and cost of debt is 10%. A number of maturity uh, maturity period in 8 years, at 8 years. And what's the value of the bond? Wait, quickly. Can you find the answer using this method? Suru says 94.67. Others? Any other answers? Others? Only Suru has responded at 94.67. The answer may be correct because it's a discounted bond, because cost of debt is high than coupon rate. It should be a discounted bond. Others, please respond to your answer and do the calculation and then give the answer. Yes. Sasika says 94.715. Right. Any other answers?
Dilan Madhushanga, what's the answer? And Pavitra Andamani. Right, you do this calculation at your own risk. Then we will move to the next slide. Right. So yield to maturity is calculating the cost of debt. It is not relevant now. Right. We will discuss in the time of calculation of cost of capital. Right. All right. Can you find this the outflow? No. It's a 5 years bond, 1,000 return. Right. Now we will look into the bond values and semi-annual interest payment. Right. The early example we have talked about a bond which pays interest annually. A bond which pays interest annually. So this kind of bond is multiple period, multiple so in a year it pays multiple times of interest. The the formula for bond valuation can be modified in terms of half yearly interest payment and compounded period as given below. Right, I have already explained you how to calculate PVIF and PVIFA for multiple periods. So simply what we have to do is we have to divide the R, rate of interest, by times, number of times we get interest in a year, and we have to multiply this uh, number of times in a year into number of maturity period, right? So it's very simple. So I will explain uh, this using the early example, right? Now, so we will look into this example later. So we will do our own example, right? Right. This example, yeah, we will take this example. I will change some modification. It is 12%, and cost of it is 4. Right. Right. Can you find value of the bond now? And it pays interest. It's semi-annual bond, right? Pays in semi-annual, right? Semi-annual. Pay interest semi-annually. Right. What is the value of the bond? Can you do it? Shall I do? No one respond. Are you there? Can you hear my voice? Okay. I will do it, right? Sasika says, okay.
Explain, sir. I will do it. Right, we will use this formula. Right, value of the bond is interest into PVIFA plus maturity value into PVIF. Right. Right. I will ask some questions. Uh, how many times? How many times you can receive interest in a year? How many times you will receive interest? 2 times. Yes, you will receive interest 2 times. N now N. Well, you will receive interest 2 times. For how many years you will take? For how many years you will take interest from this bond? 5 years. So therefore, how many times you will receive interest? How many times you will get interest for 5 years? 10 times. Yes, 10 times. Per year you will receive 2 times, and for 5 years you will receive uh, 10 times. Now the coupon rate. At a time, how much you will receive interest at a time? At a time, how much you will get interest? 120. No, 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 no. Suru says no. 120, not 120. Any correct answers? Yes. Darsika says 60. It's a correct answer. Right? 120 rupees per year. Right? Per year. Right? So simply we calculate, you will get 120 per year, but you will get interest 2 times. Then simply 60 rupees. Simply 60 rupees. Then cost of debt. So what's the cost of debt? For this calculation we have to take. No, Sasika says no, not 8%. 8% is for year. For a year, 8%. So 8% divided by number of times. Number of times. Then it's become you 8 divided by 2. Right? Then 4%. Right? 4%. Now we will find PVIFA and PVIF. Right? So what's the PVIFA? You know that 10 years at 4%. 10 years at 4%. What's the PVIFA? PVIFA is simply 10. The period is 10. The cost of debt is 4. So we apply PVIFA. Right, annuity, no, it's annuity. So it's 4%. This is 4% for 10 years. 4%, 10 years, right? This value, 4% at 10 years. PVIFA, this value. PVIF, PVIFA, 10 years and 4%. And also PVIF for 10 years and at 4%. And we have to 4% at 0.675. Right? So we have taken the value. Now we move. Right? We will take interest. How much interest per time? 60. Right? 60. And PVIFA equal this value. And maturity value, how much maturity value? Any of you? Maturity value? End of the period, end of the maturity period, how much you will receive? Yes, 1000, exactly. Exactly 1000, right? End of mature, you will get 1000. And PVIF equal this value. Now we can find the answer, right? This value into this equals sum. 1162. This is the value of the bond. Is 1162.254, right? Right. Anything to ask? Anything? Anything to ask? You can. If you wish to ask anything, you can. Right. Then I will give you one more example for your work. Fatima Rispa says no. Right. It's clear. And example. I'll give you another example for your work. Right. Interest paid at interest paid quarterly. Interest paid quarterly. So what's the value of the bond? Please do the calculations. Same information, but the thing is the bond pays interest quarterly. So what is the value of the bond? Please work out. What's the answer? Right, 1000. Right. My students are very clever. My product, I proud about you. Right. And now you check this answer. Is it correct? It is correct, but you can do in your own way. Right? You can do it in your own way. Suppose 10% year bond, rupees 1000 uh, has an annual rate of interest for 12%. The interest is paid half yearly. What is the value of the bond? Right?